Investors also focusing on President Trump's repeated attacks on the Federal Reserve. We've got Joel Griffith, who's the Heritage Research Fellow, and Ian King from Bayern Hill. He's a senior research analyst. Thank you both for joining us this morning. I'd like to just jump right into it, Joel, starting with you. So what do you make of the president as well as investors emphasizing these Fed hikes? Do you feel like it's possibly misplaced?
I think some of the emphasis on the rate hikes is misplaced. The fact of the matter is, going back 10 years, the Federal Reserve intentionally reinflated two asset bubbles, the housing bubble and the stock bubble. And they did this intentionally, and they succeeded in that. So this, President Trump did not create this bubble. This was created before his presidency and continued throughout, and now we're going to deal with some of that. But I think we need to look at fundamentally, the economy does appear to remain strong, and it's certainly growing at a more robust rate now than it was in the final year of President Obama's last term.
I'm actually going to stick with that theme since you brought up bubbles. Ian, the economy is growing, which was just mentioned, but what about debt? Do you think that the debt market is something that we really need to be concerned about?
Sure. I agree with Joel in the sense that the Fed has reinflated multiple asset bubbles. This is what the Fed does. Monetary policy is a blunt instrument. It's not very surgical. And insofar as we might have exacerbated the virtuous cycle of the economy with the tax cuts of 2017, 2018, I think now we're starting to see the other half of that cycle. As the pendulum has swung to optimism so high in 2018, I think from an economic standpoint, we're going to swing back the other way. The market's already dropped. We're in a bear market. We've been in a bear market since October. The heuristic of 20% qualifies as a bear market, but I think we've already entered a bear market, and I think it's going to stay this way for the foreseeable future.
So, Ian, you just actually mentioned the negative externalities of these tax cuts. But, Joel, I was reading your note prior to just today's show, and you were talking about possibly suggesting more tax cuts going into 2019. But I'm a little bit confused about that, given the lack of investment that we saw from companies this year.
Yes, you're absolutely correct. We need to focus on what actually produces long-term growth. Consumer spending is part of it, and we've seen that over the past year increase. What we need, though, is to stoke long-term business investment. These tax cuts were definitely a positive. Longer term, you can expect these tax cuts to add about 0.3% to the annual GDP growth rate, and that's wonderful. But to actually produce more growth, we need to focus on continuing to flatten those tax rates and to actually stoke capital investments. And that did actually slow last quarter. We need to ensure that we increase that for the long term.